Hello Propenomix people, and welcome to the Sunday supplement from the 12th of May 2024. And this week's was called One Domino at a Time, which is a reference to what happened in the Bank of England Monetary Policy Committee meeting, with one more person on the committee crossing the floor, as they call it, to vote downwards on the interest rate. That moment that we've all been waiting for since December 2021, and this hiking cycle all started. So, as you'll know, I like to start with a quote. And this week's is: the journey of 1,000 miles begins with a single step. And that's Lao Tzu from Tao Te Ching, 6th century before the Common Era. Now, before we get started in earnest, I just want to talk about our upcoming property business workshop. We're taking bookings already. We've only got a handful of the super early bird tickets left. So this time, Rod Turner and I are taking on the fundamentals of property investment, risk mitigation and control, relevant investment metrics, differing secured debt arrangements and loan structures, and scaling your property business portfolio. When, why, and how. That'll be Thursday the 4th of July in a central London location in Blackfriars. And as I say, the super early bird tickets are available. I'm grateful to all those who do book early, because it means we can book a room with some confidence and organise the event. And there's 20% off for the super early bird ticket. So there's no gimmicky sales or offers here. That's the best offer that we do. So pick your last one up if you can. bit.ly/PBW THREE, PBW3. Thank you very much. So, supplement proper, everyone. All eyes were on the Bank of England to see if a crazy Morgan Stanley prediction of a rate cut would come true. They were calling a rate cut in May. They were wrong. It didn't, but a domino did fall, as I said earlier. So 7-2 to preserve the rate at 5.25, 2 voting for a 0.25% cut down to 5.0. I get stuck right into the Bank of England MPC meeting minutes report later on. They do a full report once every 3 months, and that was one of these meetings, so we have to get stuck into that. But before that, of course, as usual, the macro starter. You know we're going to talk about the 5-year gilt and swap yields. We have to. We're still sweating those, and we're going to be doing so for the next few years, let's face it. But we need to have a chat about the construction PMI, because there was a surprise surge in late April. But as always, the detail is key, and I'll get into that. The RICS house price balance, which is an important metric for us in the property sector. And of course, we couldn't possibly leave out the growth rate figures, especially as they were quite a surprise on the upside for a change. So we also have to talk about those, because they will play into the next Bank of England meeting, which is now a little under 6 weeks away. And the game of chess is really going to get interesting from here. Little bonus though, before we kick off on the macro, an amuse-bouche, if you will. I want to make more of a regular feature of sneaking in the news from Property Stato, Christopher Watkin, the best provider of real-time residential property market stats in the game. I think I should be sharing these weekly, and I'm going to endeavour to do so from now on. So I'm reappropriating his headline once again, as I did last week: best fortnight for the UK property market in 2 years. Tail of the tape, realistically, listings still very strong. Net sales up 21.4% year on year last week, and 13.7% higher than the 2024 average so far. So definitely gathering momentum, this market. Of course, there's a bit of seasonality in that. We're normally at a good time of year. And let's face it, houses look better in the sunshine. But still, we have to bear these things in mind. Gross sales up 8.2% on the 2017 to 19 average. And that's the key, because we're looking back at that market before the pandemic, which was a fairly flat, healthy and reasonable market. Nothing necessarily truly racing away. Of course, in individual locations maybe, but that's always the case. So the market's looking healthily normal really at the coalface, in spite of the interest rates. The market likely has a good number of buyers who have a rate fixed below the current best rate, since there's been a rise in the past few weeks. So perhaps we need to factor that into everything before we get too overexcited. But certainly nothing to be worried about there. So good news. Onwards then. It's hard enough to make room for only 4 areas of interest this week on the macro, but that's the way that it is, and that's how I limit myself to the mere 5,000 plus words that I knock out every week. Construction PMI had to make it, as I said, because it was such an increase on the flash PMI from just 2 weeks before. April printed 53 in the end, and I thought, blimey, have I been underestimating the sector or overstating some of the roadblocks for the house builders? But just as this week, we seem to have been peppered with articles about the state of play, how to fix the housing crisis, etc., etc. Shelter's demand for 90,000 affordable rental units to be built each year, etc. Of course, the problem with the concept of affordable rent, which is set at up to 80% of today's market rent, is that's what market rent was 3 or 4 years ago, thanks to inflation. But that's where we are. So, As always, we've got to get into the weeds here. You know that by now. The headline in the S&P report was fastest expansion of construction output since February 2023. But when you get into the sub-headlines, growth led by commercial work, civil engineering, house building declines again in April, and supply conditions continue to improve. Why did house building decline fairly sharply? Remember, it's 1 month, so we shouldn't get carried away. But sluggish market conditions and elevated borrowing costs, apparently. Not really that much news. Although obviously market is moving okay. But remember, the market for new build was preserved very well in 2023 with a lot of skill by the house builders, restricting supply apart from anything else. So they did well in a pretty poor market, or they did as well as they could do. So of course they're still going to be stuttering through as the broader secondary market still improves. So the RICS house price balance, there was a brief murmur of there being a positive print for April that didn't quite come to pass. Consensus ended at -2 and the actual print was -5. So pretty much as many surveyors thinking things are going up as they are going down in April. It included reports of flat buyer demand, slight softening in near-term sales expectations, but very consistent with what we've seen in the movement in the interest rates, to be honest. But remember, April's pay packets will be higher, and that as yet has not been factored in anywhere, of course. The next 12 months is still in expansionary territory according to the survey, but listings continue to rise. Those looking to sell feel they've waited long enough. The survey does say that a loss of buyer demand impetus is concentrated in London and the South. Sales agreed at +5 was the first positive print since early 2021, which is good to see, and congruent with Mr. Watkins' reports of a buoyant market according to the sole subject to contract figures and real-time data. And remember, Chris is a couple of weeks ahead of this because this is the report from April and we're nearly in the middle of May now. So, whilst the next 12 months looks positive, the next 3 months printed a -1% in expectations. So a flat market is the current feeling as we go into the summer. And on goes the broken record once again. Just you wait till they announce that election. Of course, nothing better to derail a market trying to move forward. +33% see stronger sales activity over the next 12 months, which is plenty strong enough, but down from +46% for March, so a bit less bullish than they were. Average stock levels are now at a 3-year high, 43 properties per branch for sale, back to pre-pandemic normal, arguably. 12% reported increase in tenant demand, so still moving forward, but that was the lowest print since April 2020. So still more reporting more tenant demand than less, but that just shows you what a crazy rental market we've been in for over 4 years now. -13% was still the landlord instruction print, so it's still moving downwards but more slowly. +33% see rents rising still. So just a reminder, these plus and minus percentage figures here, that would mean 2/3 of respondents saying rents moving up and 1/3 saying they're not moving up, so they're sideways or downwards. Or you could say rents are now static or falling in 1 in 3 areas according to the survey. That would be a fair reframing of that. Now we've already heard that London, apart from anything else, is bumping its head against that affordability ceiling once again. And of course, there are a heavy amount of rentals in and around London. Much larger percentage of stock is rental than it is in broader parts of the country. So on to the growth report from the ONS. It was a surprise even to those of us, well, me, who predicted 0.4 to 0.5% growth for Q1 2024. The likes of the National Institute of Economic and Social Research were predicting plus 0.2 back in January, when I first put that prediction out there on the back of some very positive looking PMIs and lower gilt yields. Even I was too bearish, as the print was actually plus 0.6 for the quarter. As usual though, the growth report deserves a deeper dive. March saw GDP up 0.4% on the month, so Easter being early and February being rained off clearly had a better impact than Good Friday slipping into March this year, as bank holidays traditionally hurt GDP. February was revised to 0.2% and January stuck at 0.3%. How you put those 3 monthly figures together and get a quarterly figure of only plus 0.6, I don't know. It's mathematically impossible. You can't go plus 0.3, plus 0.2, plus 0.4 and only end up at 0.6, even with rounding errors. It grinds my gears, but the error seems like, if anything, quarterly growth will be revised upwards, not downwards. Let's see. The ONS boffins are, of course, far more mathematically able than I am, but it drives me mad that they don't explain what looks like an impossible anomaly. Just me? Okay then. So the recession is over, whichever way you look at it, and no one really seemed to notice. There is still chat over the cost of living crisis, but the Google Trends graph is quite illuminating there, We're about 1/6 of the number of searches of cost of living compared to mid or late 2022 when it was really biting. The searches really died off around February this year, although I personally had said I'd laid it to rest a few months before that. Services were up 0.5% for March, really hot on the back of the PMIs that have got even hotter since then. Annualised UK growth based on Q1 is 2.5% compared to 1.6% for the US. First time we've been ahead for a long time. And up 0.7% for the quarter, apparently. Production output was up 0.8%, but construction output was down 0.9% for the quarter. But remember, the PMIs were under 50 in construction until very recently. There's a story in here somewhere, though. When you look on a year-to-year basis, the increase is only 0.2%. Of course, we did have those 2 consecutive quarters of pedalling backwards. That's how you get a technical recession. So at least we're still up since then. Still, it's a lost year in the books, whichever way you look at it. But what of construction looking back at Q1? New work was down 1.8%, maintenance rose by a mere 0.3%. Private commercial new work was down 5.3%, but looks to have picked up according to the PMIs, so perhaps that was just a seasonal blip. Infrastructure new work was down 3.6%, which is significant, of course. Whichever way you spin these figures, though, no one had predicted an economy quite so buoyant coming into 2024. Sunak, Hunt and the rest who believe that the person on the street is really feeling this, or even cares after the grudges they're harbouring against the Tories, will be feeling unexpectedly jubilant, I'm sure, and I can hear the shouting in the Commons already about the best Q1 in the G7. Anyway, that leaves us with our favourite, the yields. We had a drive in the morning on Friday, trying to close the week under the dreaded 4% yield on the 5-year, but we closed at 4.044. Given that we opened the week at 4.107, we'll take it. It was an incredibly boring week in the gilts market, really, apart from Friday's efforts to get down to about 3.95, which were rebuffed, suggesting that equilibrium really does look above or at 4% at the moment. I have my own thoughts on why that happened. Big bets on the back of the Bank of England language in general, and I'll get into those when I get into the Bank of England MPC report. The swaps, the gilt closed Thursday at 4.008, and so the swap, continuing the discount we've observed over the past several weeks, had closed at 3.92. Lower than 12 months ago and lower than 1 month ago. And that's the first time I've been able to say that in the past couple of years as it goes. But only just. It's all very close. They were all around that 4% mark. Treacle then. Still at the top end of my range, but just about going in the right direction, it seems. So, we're filled with macro. Once more into the breach, dear friends. As I say, every 3 months you get a full report on monetary policy from the Bank of England, which is every other Bank of England monetary policy meeting. The report runs to a tidy 87 pages. Don't panic. Luckily, there's a summary. We also need to get into what the important players at the bank have said since the meeting, because their language is so critical, and they know that. So let's just revise for those who don't remember the outcome of the last meeting with complete clarity. Probably because they aren't obsessed with all of this. I am, in case you haven't worked that out by now. Last time we had a vote of 8 to hold the rate and 1 to cut. This was the first meeting that someone had not voted to raise rates since Q3 2021. That was our first milestone. The one cutter from last time out is a committed dove and has been focusing on weakening consumption data. From everything I've seen and discussed in the previous week, she's right to be so, although I do think there's an element of tunnel vision. She was never going to be the difficult one to persuade to cut. This week's was 7-2, as I've said, and that means someone else has crossed the floor. A big deal. Somehow, the economy is holding up in the face of weaker consumption and has grown in Q1, as we've now seen evidence of at this point. So you can understand why the others are not so worried. But this one move is bigger than the initial move to cut from Dr. Dingra, the dove. Remember one more thing as well. This has to be a prediction about when you want this to kick in. This is easing, and that would start to take hold from around November this year, if it had happened at this meeting. That's the very tough part of the job. There's one more big point that might well be impacting people like Dave Ramsden, who is the second cutter, Deputy Governor for Markets. Historically, in these sort of cycles, he will be aware, I'm sure, the cutting has happened either too slowly or too late. That might well be playing on his mind, and I could understand that. Anyway, we get into the full wargaming nearer the end. That's just to set the scene. To clarify, those two cutters voted to cut by a mere 0.25%. A token nibble, it would be described as. The report was before the growth figures were released, and the first question that many would ask is, Why cut if the economy is doing fine? We do need to remember a cut will take 6 months to have an effect or more. Back to the summary. The market implied path using the forward rates is, to be clear, the expectation the bank will cut the base rate from 5.25 to 3.75 in the next 3 years. That's moved up a whole 0.5% from the last report 3 months ago when the expected endpoint was 3.25%. So that's fairly big news, and that explains a lot of the gilt market, apart from anything else, because we're about 0.5% up on where we were 3 months ago. The next part of the summary suggests that underlying inflationary pressures have continued to moderate somewhat in the USA. This isn't really true. Well, it's just wrong. And it bothers me that they would even say it. Inflation has just gone sideways and a touch upwards in the USA since the start of 2024. The bank was still predicting 0.4% positive in Q1 growth. The report was released 1 day before the growth figures were out, and they forecast plus 0.2 in Q2. Given we're very nearly halfway through Q2 already, and the PMIs have been roaring, it will take something to go quite badly in the second half of this quarter to only increase by plus 0.2. Perhaps Easter is a net positive in general. I'm not really aware of this phenomenon, but I haven't studied it in any detail. So missing it in Q2 where it normally sits will cause a base effect downwards. I'm not sure. But right now, I'd stick it a pin in between plus 0.5 and plus 0.6 for Q2, personally. The bank still sees demand growth as weakening. The pragmatist in me says that's not happening quite yet, and April's pay rises will contribute yet further. The problem that I've already told you that the decision makers will be facing will be a low-looking inflation figure thanks to energy prices dropping and wages roaring according to April's figures when they're out. There's 2 sets of inflation data, 1 more growth print and 2 more sets of jobs figures before the next Bank of England meeting. The bank does highlight high up in the summary that services inflation is still sitting at 6% and wage inflation is also still sitting at 6%. The bank is now forecasting inflation at 2.5% in the second half of 2024. Personally, I can't see how it doesn't go higher, but I'm certainly in a minority there. But I'm comfortable there. Some would say I belong there. One of the most important points is that in 2 years' time, the bank sees CPI at 1.9, and in 3 years' time, the bank now sees CPI at 1.6, i.e. below target. That leaves room, you would think, for a cut. The last report had these numbers at 2.3 and 1.9, which didn't leave room for a cut. I'd love to know whether it's this fact specifically that influenced Dave Ramsden. Let's pause there for consideration. I sometimes flippantly refer to the whole target piece as a bit of a glorified scam. You get 3 years to get to a target and you get away with a lot in the interim, basically. I was jumping up and down in 2021 about all this because I said there's no way we'd be at target in 3 years' time. And indeed, it's come to pass that I've been right about that. Although April's print, which is out in 10 days' time, may still hit that target, even though I think it will be a shade higher than 2%. These sort of inflationary cycles take 3 to 5 years to play out. The central bank always does the same thing. We're not a lot smarter than we were in any of those cycles, but we do have better and more qualified people in charge of those levers than we did historically. That's not the only point though, or it would be easy to get lost in that point, perhaps I should say. We also need to consider what the job of a central banker is. They're not supposed to be making knee-jerk or in-the-now decisions, much as borrowers want them to when they're suffering from paying higher interest rates. They need to make decisions that are robust over decent time periods, and their changes don't take effect straight away unless they are stark, dropping the interest rate to a 300-plus year low, for example, in the face of a crisis. They do affect bond markets in real time, but the wider economy not so much, because the wider economy isn't affected by those bond markets in a particularly fast fashion. Therefore, the 3-year forecast period makes a lot of sense, you could say. It's definitely defensible. The problem that I have left, of course, is that the forecasting record of the bank is completely woeful. That's been picked up in the Bernanke report, which I've referred to a number of times, and there are the small changes you can already see in this quarter's report that I've been analysing here. Are the models suddenly brilliant overnight? Of course not. There will be months of tweaking, testing, reviewing, and then the politics of changing something that's quite obviously been wrong for some time without leaving people with egg on their faces, naturally. So I do believe that as we sit today, if we cut rates to 3.75 over a 3-year period, that inflation would be 1.6. It's possible. If the economy is particularly limp, it's definitely possible. Is it the most likely scenario? No, I don't think it is. There's this amount of extra inflation that I'd think, from the research I've done, sits somewhere between 0.5% and 1% that we'll be dealing with for the rest of this decade, if not beyond. You would need an econometric model beyond my capabilities to get any closer than that. We have not only the services inflation and wage numbers, remember 6% treble the target, which are moving downwards, but tend to move downwards at a very slow pace. A roaring services sector right now in better shape than it's been for some time, with natural inflation and still a lot of people living off cheaper debt than before. And that drop off is the counterfactual, if you like, because what happens is as things drop off, well, month to month, 100,000 people or so drop off a fixed rate mortgage that was around 2 or 3% and have to take a mortgage at an average of 4.7 at the moment, we are told. That near as damn it doubles the interest payment, although it doesn't double the mortgage payment because the capital repayment amount remains the same. And there are scrambles that can be performed also. Capital repayment holidays, extension of terms which will lower the capital repayment contribution. All of these tricks have been made available and used. The mortgage payment moves up by around 50% with very crude maths without any of the other tactics being used. On the flip side, we're now 2.5 years into this hiking cycle. At least 2 pay rises have been obtained, an average that approaches 15% pre-tax. That will equate to about 13% post-tax, because some income always comes before tax thanks to the personal allowance, of course. Inflation in that time period also isn't far off that, so there's less money for consumption. That's a fact that we're seeing year on year. There's also that returned incentive to save, which is chopping into UK consumption right now, and I do struggle to see how it's holding up so well. But what I suspect at a very broad brush approach is that the wage increases are concentrated at the lower paid end, and that socio-economic group tends to consume 100% of all of their pay rises, whereas the better paid are increasing savings and keeping their belts comparatively tighter, perhaps because of concerns of wars in Europe and on the borders, perhaps because of economic and election concerns. We'll see as the year plays out. People stop dropping off the generous debt in 2.5 years' time, or from a mortgaged household perspective, remember that's only 28% of households anyway, but only if they were on 5-year fixes. We know from previous charts that I've shared on social media that 25% or so were using 2-year finance, and a smaller group, 10% or so, were using longer than 5-year finance. Some were using variable, so have been riding the lightning throughout. But the point is we have 2.5 years left for the cheap 5-year deals to expire, so that drag effect will continue on a whole number of households for 2.5 years yet, maybe about 60 or 70,000 a month. If we all accept we aren't seeing rates sub 3% on household mortgages within 2.5 years' time, which looks likely, although there's never any guarantees, of course. Either way, I find myself in a position now where I'm arguing that inflation without energy prices dropping looks more like a 3% number than a 2% number. And those factors like wage inflation perhaps dropping at an arbitrary 0.1% per month until they settle around the 2.5% mark, or maybe more if inflation settles around 3%. That would take 35 months, or basically 3 years, which takes us to the target period. Well, a shock event could, of course, change, but this labour market looks inherently tight. 3% inflation is by no means a disaster, and likely helps the government, and as property investors, we shouldn't be unhappy about it either. Rather than obsessing over decimal places, that's an acceptable level of inflation, and the Bank of England, in my view, would rather stay above or at the target than below it, because below it is not where anyone wants to be at this time. The government would definitely agree with that sentiment to inflate the debt away and keep the tax take pumping upwards thanks to those evil frozen thresholds. The long tails can subside at their leisure, and the bank is in a position, thanks to their model, to now be able to vote to cut. If at the August meeting their next report was going to suggest that without a cut inflation will be 1.3 or 1.4 in 3 years' time, I think there would be questions as to why the cut hasn't come about. Now, that level of reporting tends to only come out at the quarterly meetings accompanied by the full report. Although I can't believe they don't get updated models presented to them at every meeting in real time, but they're not reported on apart from in the quarterly report. So I don't know. So bear in mind I don't have perfect visibility or information because I've never been on the Monetary Policy Committee. It does leave the floor wide open for a cut in June, although I still personally think August is more likely. If we were well above 2% for April's inflation, even in the very favourable circumstances we're seeing for CPI, with those energy prices dropping thanks to the cap, that would be a surprise. But I think the mortgage drag will keep on keeping household consumption down enough to suppress those figures. Spending is still 8% down compared to last year on debit and credit cards, according to the ONS. That squeeze is concentrated mostly in the 55 plus demographic, who are spending 16% less than they were at the beginning of 2020. although the source of that is Revolut, and I'm not sure that over 55s using Revolut is representative of all over 55s, but it does make sense from a cultural perspective to suggest that they are the generation who will see most benefit from savings rates back up at the 5% mark or so. So the question I ask myself is who can cross the floor, as in which members of the committee could change their mind. I think we're now in a place where the two cutters will stay as cutters, and there are two who definitely won't be voting cut next time out, and one who probably won't be. But there is a possibility right now of everything from 6-3 in favour of a cut to 6-3 in favour of holding. I suppose we could get 7-2 again, but it's the most lively meeting for some time. It's a big deal, the difference between those two, of course. The result will depend on the data largely between now and then. It will depend on whether we miss the consensuses to the upside rather than the downside. You'd expect April's growth figures, which will be released in June, to be pretty good, given where PMIs were at in April, although I still don't know about that Easter effect. But anything lower than 0.1% growth would be a surprise, I think. May looks very positive thus far, so you'd have to have that pegged in at 0.2 to 0.3, again, although obviously we're only halfway through. It's difficult. In fact, I'd say that the next meeting, as we sit today, is the toughest meeting to predict, certainly since September 2023, when they opted to end the current hiking cycle and the vote was 5-4. That was a tough one to predict, and I predicted 5-4 the other way. One vote out, but of course a different result because they held the rate rather than raising it to 5.5. I think the next meeting's even tougher than that one at the moment to try and predict. Then we need to think about human behaviour. It would only take one person to remind the committee that they started hiking too late, a fact that's now universally accepted, and point out they don't want to start cutting too late. And Dave Ramsden might just be that one person. Language is everything though. The report's penultimate paragraph is fairly clear. Monetary policy will need to remain restrictive for sufficiently long to return inflation to the 2% target sustainably in the medium term, in line with the MPC's remit. That's the 3-year period they're talking about. The committee has judged since last autumn that monetary policy needs to be restricted for an extended period of time until the risk of inflation becoming embedded above the 2% target dissipates. Now, if they mean that, they aren't cutting rates for quite a while yet. I'm not sure if they do, and I'm also not sure if the fact that they mention last autumn deliberately makes it sound longer ago, because now the sun's outside, it feels like summer, officially it is summer, and therefore, well, I suppose it's not necessarily had St Swithin's Day yet, but it feels like summer, and therefore last autumn feels like a long time ago. I'm not sure if that's deliberate or not, but I'm always suspicious of the language that they use. It doesn't sound like a cut in 6 weeks' time to me. The changes in 3 months to the bank's forecasts are pretty massive, to be honest, and I use those as this week's image. The big one is that bank rate for 3.75 in Q2 2025, that was the prediction, is now expected to still be at 4.5. So that's 0.75% above where they thought 3 months ago. That looks a lot more realistic to me, and that also speaks to the robustness of the gilt yields at the moment. The expected pace, according to the market curve at the moment, is one cut every 6 months, which would be painfully slow and very orderly, and would represent the soft landing scenario, which now does look the most likely in and of itself, but I think is still only looking about 40% likely. All bets are off in the event of exogenous shocks, and the current advance of Russia throughout Ukraine, now getting precisely zero coverage since the West preoccupies itself 100% with the Gaza situation instead, could easily cause the next exogenous shock. Growth forecasts are nicely upgraded now, but the bank's forecast for growth still look too low to me. Why are they predicting 0.2% growth for GDP for Q2 when the real-time data looks so good? We're 40% of the way through Q2, so it's hardly difficult. It looks ridiculous compared to the NISA forecast of 0.6, National Institute of Economic and Social Research, and that's very much in line with what I've said about April and May thus far. They, like me, are basing this on very positive PMI readings for services, and that's using their base case for June being about 0.2% growth. Getting anywhere near 2.5% a year is a great result, though, at the moment. The problem with this is, if NISA and I are right about Q2, then that really takes away from the case to cut interest rates. If anything, remember that sentence from the S&P Global Flash report just a few weeks ago, which has now mysteriously disappeared from their website, interestingly enough. These economic conditions look more like one where rates need to go up rather than down. Positive economic news like this will see limited calls for interest rate cuts. People will feel it in their pockets for mortgages, but an economy growing at 2.5% will start to lift all boats, finally. even if we're only getting back to where we were in 2018 to 19. The voting public won't forgive the idiocy that has presided over the UK since then, even if, speaking truthfully, the pandemic is probably 80% to blame for all of this. So I'm off the fence. As at today, I see no cut in June and a chance of a cut in August. But I need to be convinced as yet that the brakes are coming on this patch of economic growth. They will do at some point, and I'll be glued to the data so that I can call it as I see it right here in the supplement. The 4.5% base rate a year from now looks quite realistic to me at the moment. And with these economic conditions, I'd say 4.5 to 4.75 in 12 months' time might be quite realistic. Let's hope I'm wrong on the bearish side and it doesn't still start with a 5, is all I will say. But that's not impossible. So, well done as always for getting to the end. Remember those super early bird tickets for the next Property Business Workshop, Thursday the 4th of July, bit.ly/PBWTHREE. There's only one way we can all deal with this continual noise, of course. Keep calm, always listen to the supplement, and carry on. Thank you.